Joining us right now to talk more about all of that is Federated Investors Chief Equity Market Strategist Phil Orlando. Phil, great to see you. Thanks so much.
Thanks for having me back.
Does the backdrop in terms of all of this great economic news coincide with where markets are right now?
This is exactly the topic of the piece that I wrote last week, and I think this is what's going to happen at this election. The choice between the circus and the noise in Washington versus the strong underlying fundamentals of the economy. Dagan touched upon it. We've got the strongest economic growth in 4 years, the strongest corporate earnings growth in 7 years. Many of the consumer and business confidence metrics that we're looking at are sitting at multi-decade cycle highs. That didn't happen just by itself. It's a function of a change in fiscal policy. And so one of the things that I find most interesting is that there has been a significant change in voter demographics just since the election in 2016. Democrats have lost a couple of ticks. They're sitting at about 27-28% of the electorate. Republicans have lost a tick. They're sitting at about 26 or 27%. Independent voters have increased to about 44% of the total voter population in terms of registered voters. That is the biggest voter bloc. So the question is, are those folks, on balance, going to be opting to vote for their pocketbook or for other issues? And that's something that's going to be decided in 3 weeks.
No, I think you make a good point, because most of us are not monolithic, right? We might lean to the right on certain things and then lean to the left on other things, sort of hanging out in the middle. But when you look at the economic story, you would expect that people are feeling better today than they were 2 years ago.
There's no question. You talked about Dr. Summers at the top. We could have talked about, Austin Goolsbee or Jared Bernstein.
Or Krugman. How about Krugman?
Exactly. Any of the top economists, sort of the classic Keynesian type economists, were missing sort of the Larry Kudlow supply side story, if you will.
Yeah.
And there's what we're seeing right now, in our view, is sustainable, is not a 1 quarter sugar high, and that's been one of the criticisms.
Yeah, but with better growth comes higher interest rates, James.
Yeah, I think that is a question. You had Professor Feldstein on yesterday talking about what happens to the economy if we get to 4 or 5% rates. Seems to me getting on a Fed funds rate up near 3% is not the end of the world. It's still lower than it has been often in history. How do you see the effect of rates on this burgeoning growth we've been talking about?
And I think this is one of the issues that helped to spark this correction we saw in the markets over the course of September and early October. So you look at, we now have the minutes from that last FOMC meeting. And there's a significant divergence, I think, between where the dot plots are and where the street is. All right, the Fed has told us we've got 1 more hike this year, 3 hikes next year, 1 hike in 2020. That'll take the funds rate up to about 3.5%. The street is thinking the Fed ought to be done at 3% by the middle of next year. So what the street is saying, questioning, is what does the Fed see that we don't see? Is there a policy error brewing? Do they have the potential to over-tighten the economy in 2020, just as things are starting to top out, and then the bond vigilantes come in and start to put money into the bond market? We don't know the answer to that question, but that's something that I think the market was concerned about, and we're paying attention to.
In terms of interest rates, though, we've been in a multi-decade trend of longer-term interest rates falling. And people always say, well, the economy was fine, and I remember when a mortgage wasn't, it's 4.9%, about 5%, 30-year fixed right now. I remember when they were 8% back in the early 90s. Well, yeah, and that house that's selling for $1.3 million outside of New York City sold for $300,000 when mortgage rates were 8%. And people need to factor in all these assets will be worth less if interest rates go up too far too fast, right, Phil?
There's no question. And I know that Trump has been very critical of the Fed tightening policy, but the reality is that I think what Powell and the Fed have done is exactly the right policy, trying to normalize rates given the much stronger economic backdrop. The question is, will they go too far, too high? And in our view, 3% for the funds rate is a good terminal value. We think Treasury yields will get up to 3.5% by the end of next year.
By the end of next year?
Yeah, by the end of next year. Our target was 3.25% for this year. We actually hit that a couple of weeks ago. We're at 3.5%. So we think that the process is grinding higher. Inflation grinding higher. Treasury yields will get a little higher. But we don't see the 5% Treasury yield that Jamie Dimon, for example, talked about a few weeks ago.
I mentioned that 8% mortgage rate. The reason that I use that as a benchmark, because since the early 70s, since 1971, according to Charlie Brady, the 30-year fixed rate mortgage has averaged 8.1%. So even if we get back to average, we're talking about a 30-year fixed rate mortgage that's 3 full percentage points higher than it is right now.
And there's no question that the housing market has been one of the areas that's been slow here over the course of the last year. Right. And I think at the margin, the higher mortgage rates, the pressure on first-time home buyers from $1.5 trillion of student loan debt, higher wages, higher raw material prices, they've all contributed.
And change in tax treatment to mortgage interest, and also the cap on property tax deduction.